Good evening, everyone. Welcome back to our ICS session on financial management. How are you all? All good? Going fine? Great. Let's continue with our chapter of ratio analysis, in which we have done some of the important ratios. And in today's class, we will be talking about the other ratios and also doing some sort of numericals in today's class and some other numericals in our revision class that we have. Okay, so first up, uh, talking about the types of ratios broadly, we have, let me just quickly recap what we have done till now, and then we can take it forward. Yeah. So first and foremost, we define that there are broadly four categories of ratios. One is a short-term solvency, long-term solvency, efficiency, and return or profitability or return on investments. Okay. Then we discussed about the current ratio being current asset upon current liability, which indicates for every 1 rupee of current liability, how much of current assets you have. We said that higher current ratio means better liquidity, better stability. However, we said that very high current ratio is also not good because it indicates inefficiency. So inefficiency with regards to sale, collection, investing. Okay. Then we said that the ideal current ratio we need to define, and that ideal current ratio, we stated that ideal current ratio should be this 2:1. Very high current ratio indicates inefficiency with regards to these three things, right? Then we said that sometimes the current ratio is not a fully replica of showing the short-term liquidity, because in current assets, we include stock and prepaid expenses, which are actually not liquid. That is, I cannot liquidate it easily and get it converted to money. So we thought of a new ratio, a revised ratio, which was quick ratio, also said to be asset ratio, also said to be liquid ratio, in which we said it should be current quick assets upon current liabilities. Now, what are quick assets? We say quick assets is current asset as reduced by inventory and the prepaid expenses. Cash ratio, it was absolute liquid ratio, and that's obtained as cash, bank, and marketable securities divided by the current liability. Okay. Then we said we also need to look at some ratios which will indicate our level of cash or level of liquid assets that we have, whether are they sufficient or not. So for that, we did a basic defense interval ratio or basic defense interval, which was measured in days. Yeah. So that was cash and bank plus marketable securities plus net receivables. That is after bad debts or after recurring reserve for bad debts, provision for bad debts, any bad debts that you have, that net receivables. When you include all of them, that's what you have as funds. And from that, you're going to divide operating expense per day, which will give you how many number of days do you have, or how many number of days cash do you have for available at your behalf, right? Then operating expense per day, it was simply your COGS, selling expense and general expenses, as reduced by depreciation and amortization divided by number of days in a year. Okay. Then we considered some of the long-term liquidity ratios, in which we said equity ratio indicates what proportion of your net assets are funded by shareholders' funds. Debt ratio was 100% minus the equity ratio or total debt upon net assets. Debt equity ratio, it means debt upon owned funds or borrowed funds upon owned funds. Now, remember these borrowed funds included short-term as well as long-term debt. We are yet to discuss capital gearing that we will be discussing in this today's session. But before that, we said as the equity ratio is higher, you have a greater long-term solvency but lower risk. As the debt ratio is higher, you say solvency is lower and risk is higher. And same goes with the debt equity ratio also. After that, I said we are supposed to be discussing the return ratios. Okay, so let us look into the return ratio first, and then we'll come back and discuss the capital gearing ratio. Okay. Now, let me have any look at any queries. If you have any sort of queries, are you sending? Yes, I will be uploading these notes today. Once we are done with this, I'll be uploading these notes on the portal. I've already uploaded the sources of finance. Shreya is having doubt. I have one doubt from sources of finance concept, like how we have samurai bonds in Japan and bulldog bonds in London. If a bond issued in India and in denominated in Indian rupee, but issuer is a non-Indian company, then which type of bond is this? They can be, there's no such specific name for this bond. Okay. So these are the samurai bonds or bulldog bonds, those are at international level. As such, Indian debt markets, the fixed income market is not that vast enough. So hardly you find any foreign entity coming to India and raising funds in the form of debt from India. Okay. Yeah, but to some Indian context, you have something called as masala bonds also, which you might have read in the PDF that I have already uploaded. Okay. Now, let's go for the return ratio or return on investment. See, in the last class, we were discussing about this income statement. Okay. We're discussing about this income statement. And we said that the money flows from sales and it all percolates up to the net profit for equity shareholder. And we said that EBIT was the income for all investors. Profit after tax is the income for the owners. And net profit for equity shareholders is the income for the equity shareholders. Okay. Let's talk about return ratios. Okay. Coming to return ratio. Now, always remember this term, return on investment. Yeah. Now, how do we measure this return on the assets or returns that we are going to compute? If I ask you to tell me what's the rate of return, what's the rate of return? How do you compute the rate of return on any investment? You say the rate of return on investment should be what return you are getting, divided by your investment into 100. Okay, return upon investment into 100. Now, when we are talking of this formula, so this is going to be dealt in different contexts. Like first up, I'll say, what is the return that the company is generating on on the assets? Return on assets. What should be the formula for it? Sir, if I want to know return on my assets, of course, in the denominator, it should be your net assets. Now remember, net assets means what? Fixed asset plus current asset minus current liability. Return on assets will be net assets in the denominator, which is fixed asset plus current asset minus current liability. Okay. Now, what is the return that the company is generating on this investment? What is the return that the company is generating on this return, or on this investment? On this investment, what is the return that the company is generating? We have net assets in on this. On the total investment that the company has made, what is the return that the company is earning? Is it EBIT? Is it PAT? Or is it net profit for equity shareholders? Is it EBIT? Is it PAT? Or is it net profit for equity shareholders? Tell me, out of these three numbers, what would you say to be on the numerator? Return on assets. What is the figure that the company is earning? Of course, it is EBIT, sir. So that's EBIT, right? Return that the company is generating is basically the EBIT on the net assets. Correct? Correct, guys? Yeah? Yes. I'm not talking of equity shareholder. I'm talking of total assets or the net assets that the company is having. The net assets that the company is having, definitely, sir, it is EBIT. Right? So EBIT upon net assets into 100 will give you return on assets. So how much return is the company generating? Let's say if I tell you that company is having a net asset of suppose 2 crore. Total net assets are total 2 crore. On this 2 crore, company is earning EBIT, earnings before interest and tax. Company is earning before interest and tax an amount of 30 lakh. So can you tell me what is the percentage earning that the company is having? What is the percentage earning that the company is having? What percent is the company earning? Of course, sir, 15%. It means company has got a business which is making it earn 15% on its investment. It's able to earn 15% on its investment, and that's our return on assets. That's our return on assets. Yeah. Okay. Now, this is way of understanding return on assets, which is how much the company has invested in the assets of the company, and on that assets, how much is the earnings that the company is having. Okay, then we talk of the next one, which is called as return on capital employed. What do you understand by capital employed in business? What do you understand by capital employed in business? Yep. What do you understand capital employed in business? Capital employed is the capital investment, right? Capital employed is the capital investment that the company is having. It's basically the amount of investment or amount of funds that the company is investing, right? So capital employed, understand this term, capital employed means owned funds plus borrowed funds. This is owned funds plus borrowed funds. EBIT is earnings before interest and tax. Okay. So return on capital employed. Return on capital employed. If I want to compute return on capital employed, I'll say, see, so this EBIT figure was the income for all investors of the company, right? 30 lakh was the investment for all investors of the company. So capital employed is also overall investment of the company. So on overall investment of the company, it is earning EBIT. So this formula, return on capital employed, is going to be EBIT upon total capital employed into 100, or you can also say that this is EBIT 1 minus T upon total capital employed into 100. Now, what is this? EBIT 1 minus T upon total capital employed. EBIT 1 minus T is after tax figure. That is 1 minus T is after tax, giving it the after tax effect. Okay, that's your EBIT. Now, what do you mean by this owned funds and borrowed funds? Owned funds and borrowed funds means the equity share capital, preference share capital, plus sort of reserves, minus any fictitious assets. Owned funds plus borrowed funds will be equity share capital, preference share capital, plus fictitious reserves minus fictitious assets, plus any borrowings, plus any sort of borrowings. Okay, that's your capital employed. That's the total investment that is there in the business. Whatever money is invested into the business, that is this figure. So that comes into the denominator, and in the numerator, what we have is how much return are we earning on. So we have already said that EBIT is a income for all investors of company. Now related to this, we have another return on equity. Now when I say return on equity, it means return on owned funds. Return on owned funds. Can you tell me what should be this formula? Obviously, in the denominator, we will have owned funds. Now remember, owned funds means equity share capital plus reserves plus preference share capital minus any fictitious assets. Okay, that's the owned funds. Now, what about the numerator? What about the numerator? Can anyone guess, or not guess, but actually think of what should be the numerator in my formula? If I'm talking of return on owned funds, should it be in the numerator EBIT? Should it be PAT, or should it be net profit for equity shareholders? When I say return on owned funds, should it be in the numerator EBIT, PAT, or net profit for equity shareholders? Yep, definitely, sir. When it is owned funds, when we are talking of owned funds, it should be the return for the owners, right? So now the return for the owners, is going to be PAT, profit after tax. That is PAT upon owned funds. Now, if I specifically ask you return on equity shareholders fund, or we also call it as return on equity. This was return on owned funds. That is a return on owned funds. Now we're talking of return on equity shareholders fund or just return on equity. Obviously, in the denominator, we will say equity shareholders fund. Now, what is that equity shareholders fund? That is equity share capital plus reserves minus any sort of fictitious assets. Now, can you tell me what should be in the numerator for return on equity? How much return are we generating for our equity shareholders? What should be in the numerator? What should be the numerator? Obviously, it should be the net profit for equity shareholders. It should be net profit for equity shareholders, because as we have stated, this is the profit that we have for the equity shareholders. Okay. The net profit for equity shareholders will be using in case of return on equity shareholders fund. Return on owned funds will be using PAT, and return on capital employed will be using EBIT. Right. So these three we need to remember: return on capital employed, EBIT, or EBIT 1 minus T, depending if it is before tax or after tax. For your understanding, so this is a figure which is before tax. This is a before tax figure, and this is the one which is after tax. Okay. Now, obviously, owned funds and net worth proprietary funds, they are all one and the same. Okay. Now, so if you look at the concise form, the return on assets, that tells us what percentage return is earned on assets. What percentage return is earned on assets? Then this is telling you what percentage return is earned on capital employed. Then on equity shareholders funds, we say what percentage return is earned on equity shareholders funds. Okay. So what percentage is earned on assets? For that, we have the formula of EBIT 1 minus T upon net assets, which is the after tax figure. Sometimes they also call it as profit after tax upon net assets. So what is the version of this return on assets form? Whether it is EBIT 1 minus T or PAT upon net assets, that will be given in the question. You need not worry, sir, which one is to be taken. Percentage return on capital employed, we say before tax, it is EBIT into 1 minus T upon total capital employed if it is before tax. And if it is after tax, we say it is, sir, EBIT upon total capital employed. And return on equity shareholders fund, we say it is net profit for equity shareholders upon equity shareholders funds. Now, these all are the ratios which tell you what percentage return you are earning on that investment. On overall investment, what is the return? On equity investments, what is the return? On total assets that you have invested, what is the return? Now, if you look at the query, some of you are asking, sir, what is 1 minus T? Okay, see. Your EBIT figure, earnings before interest and tax, this is a before tax figure. Okay. So if I tell you that tax rate is, let's say, 30%. So how will you compute this tax amount? This will be 30% of what? Suppose I tell you EBIT is before tax figure, and I'm asking you tax is at 30% of the before tax figure. So can you tell me what is this 30% of? This is going to be 30% of what? It's going to be 30% of what? It's going to be 30% of what, guys? It is 30% of EBIT, right? Because it's a before tax figure. This is before tax. So you will pay tax on this, which will be 30% of EBIT. Now tell me what will be the after tax figure. What will be the after tax figure? It will be EBIT minus 30 upon 100 into EBIT, right? This is the after tax figure, right? So if I take EBIT common over here, you will find we are left with 1 minus 30 upon 100. Can I say, so this EBIT into 1 minus T, because T stands for the tax rate, 30 upon 100, or 1 minus T, it stands as 30 tax rate, right? So when I want to make this before tax figure and after tax figure, when I want to make this before tax figure as after tax figure, it is EBIT 1 minus T. I hope this is clear now. Is this clear, guys? EBIT 1 minus T. Why are we taking 1 minus T? Is this funda clear? Yes, now is it clear? Raghavendra. Yes, your answers are reaching me, Raghavendra. But I don't think that you have answered anything till now. You're just asking whether my answers have reached you. Okay, so I hope EBIT 1 minus T, this funda is pretty clear, right? Yeah. Tanvi, true, we subtract interest from it, but we are not bringing in interest over here, because understand, when we talk of capital employed, we are talking of the entire business, not the return to our equity shareholders. It is only when you want to say you have to pay to equity shareholders, you will subtract the interest. Okay, but when I'm talking from the company point of view, we are just going to take that this is my before tax. So after tax, what should be the figure? Okay. What is investment? Whatever you invest, whatever amount you invest for earning return, for earning something, that's your investment. So you're investing in assets. So your investment is net assets. Your investment into the total capital of the business, that's total capital employed, is your investment. On equity shareholders fund, that's the equity shareholders fund, or I can say equity share capital reserves and net reserves are your equity shareholders fund. So these are your return ratios, broadly the return ratios that we are talking. Assets on capital employed, on equity shareholders funds. Are these ratios clear? So that now we can go for the capital gearing concept. It's a very interesting concept, guys. Can we go for the capital gearing concept? Can we go for the capital gearing concept? Mansha, yes. We do consider preference share capital in the net worth also. Preference share capital is a very well a part of own funds. Okay, fine. Are we good with this return ratios? It all tells you what is the return in percentage terms that you're earning on assets, that you're earning on capital employed, and that the equity shareholders are earning. Yep. Yes, Kunal, I'll be uploading this. Don't worry. For today's session, I'll be uploading this. Karthik asking in book ROA, average total asset is return. Average total asset means opening plus closing average. That is opening asset plus closing asset divided by 2. That's what we mean by the average. Is this clear? Okay, fine. Now let's come to capital gearing ratio. Now, capital gearing. Uh, let's have a look at the concept with the help of an example. Suppose we have three companies, P, Q, and R. Okay. Now, these three companies, for these three companies, P, Q, and R, let's say the total funds that they have invested in the business, whatever money they have put into the business, is same, is 10 lakh. 10 lakh is what the investment of the companies are. However, these three companies differ according to the capital structure. That is, total investment is okay, sir, 10 lakh. But this 10 lakh comprise of what all values? Like this 10 lakh will comprise of how much owned funds and how much borrowed funds. So let's say first company is very conservative. 10 lakh fully is invested through owned funds. Everything is invested through owned funds. Okay. And there is no borrowed funds in this. Q is taking some amount of risk with 5 lakh as owned funds and 5 lakh is borrowed. And in case of R, we say 2 lakh is the owned funds, 8 lakh is the borrowing. Okay. So 2 lakh owned funds and 8 lakh is the amount of borrowing. So total funds we got 10 lakh, 10 lakh, 10 lakh in each case. Now tell me, will the company's EBIT differ according to how they have raised the funds? Will the EBIT of the company differ according to how the companies have raised funds? That is, do you mean to say that the company having only equity share capital will have different EBIT with regards to the company having equity and debt? So if we have a company which is fully equity funded, and if you have another company which is funded with equity as well as debt, and they are into the same line of business, are they going to have different EBIT or should it be the same EBIT? Are they going to have the same EBIT or are they going to have different EBIT? So if I simply ask you, P, Q, and R, are they going to have same level of EBIT or different level of EBIT? Of course, same level of EBIT, because what you have invested in business, it will remain same irrespective of where you have got the fund. If you have invested 10 lakh, you will get return on 10 lakh. As a business entity, I'm not talking of owned funds. I'm talking of as a business entity, if you have invested 10 lakh, you will get the same return on 10 lakh, irrespective of how you have raised those 10 lakh. Whether you have to put your own money or whether you have borrowed money and invested it. Right? So obviously, all the three companies will have same level of EBIT. All the three companies are going to have the same level of EBIT. So now if I tell you that rate of return on business investment, rate of return on business is, let's say, 30%. So we get an EBIT of 3 lakh. Q again will have an EBIT of 3 lakh. R will again have an EBIT of 3 lakh. EBIT, earnings before interest and tax, is constant throughout all the companies. It does not change according to the company. Then interest. We say that the funds are borrowed at 10%. Obviously, P is not going to have any sort of interest. Q will have interest payment as 10% of 5 lakh, which is 50,000. R will have 8 lakh, 10%, so which is 80,000. So profit before taxes will become 3 lakh, 2 lakh 50,000 and 2 lakh 20,000. 3 lakh, 2 lakh 50,000 and 2 lakh 20,000. Okay. Now, tax we need to pay on the basis of your profit before tax. So tax is 90,000. 2 lakh 50,000 will have 30% tax. So that's 75,000. R is going to have a profit of or tax of 60,000. 6,000, and we will get profit after tax of 2,10,000 and 1,75,000. 2,20,000 minus 66 is 1,54,000. Now looking at these three companies, can you tell me which company has performed well? Looking at these three company information that I have put up for you, can you guys tell me which company is performing well? Which company has got a good degree of profitability? Is it P, Q, or R? Which company is having a better profitability? Yes. Which company is having a better sense of profitability? P. P is having higher profits. Company R. Someone is saying Q also. Okay. See. Okay, absolute terms. In absolute terms, you can say company P is having the highest number of profit, which is 2,10,000. But if I want to compute, sir, what's the return on capital employed over here for each of these companies? What is the return on capital employed? Yes, she's saying, where did you get the interest? Yes, this interest is borrowed funds of 5 lakh. On that, you are paying 10%. Yeah. So which company has performed well? If I'm asking you, which company has performed well? Let us talk about first the return on capital employed. Now, return on capital employed, it means how much return is this business generating? The pre-tax return, which we call it as EBIT, upon, since it is return on capital employed, we'll say EBIT upon total capital employed into 100. So return on capital employed is like 3 lakh divided by total capital employed of 10 lakh into 100, which is 30%. Right? Obviously, everywhere it is 3 lakhs, so it's 30%. But now if I ask you, what is the return that we have generated for equity shareholders or net worth or owned funds? Is it going to be same for all of them? Of course not, sir. So for the first company, it is 2,10,000 divided by 10 lakh into 100, which is 21%. In the case of second company, it is 1,75,000 upon, again, owned funds. So owned funds in the second company is just 5 lakh. So 1,75,000 divided by 5 lakhs. So that gives you like 35%. Right? Then in the third case, it is 1,54,000 divided by what's the return or what's the investment of owned funds? That is 2 lakh. 1,54,000 divided by 2 lakh, of course, into 100. It will give you what percentage? 1,54,000 divided by 2 lakh, that's 77%. See, no doubt, P is earning the highest amount of absolute profit. However, sir, P is having 2,10,000 profit, but that 2,10,000 is earned by investing 10 lakh by the equity shareholders. This 1,75,000 is earned by investing 5 lakh by the company Q. And this 154 is earned by investing just 2 lakh. So now if I ask you, which company shareholders are having a better return? What will be your answer? Which company shareholders or which company owners are actually making good amount of profits or are having greater returns? Which company owners are having greater returns? Is it P, Q, or R? Which company owners have the highest return? Of course, it is company R which is having the highest return. Of course, it is this company R which is having highest return. Now, my question to you is it always a case that company R, is it always a case that company R is always going to have superior returns as compared to P and Q? Is it a case that company R will have superior returns always as compared to P and Q? Is it always that owners of R will have highest return as compared to the other two companies? Is it always? Yes? Raghavendra is saying yes, sir. Yes, sir. Company R owners will always have better return. Is it a case? What about others? No? If interest rate becomes more than ROI, it will fall. Okay, Karthik, true, correct. When cost of debt is higher than cost of equity is dangerous. Okay, depends on equity share portion. Okay. Okay, let's do one thing, guys. Let's look at uh, the same scenario, that is same debt equity capital. We say in first case, owned funds is 10 lakh, borrowed funds is 0, total funds is 10 lakh. Owned funds in the second case, it is 5 lakh, borrowed funds, it is 5 lakh, and here it is 10 lakh. And the third company was 2 lakh owned funds, and borrowed funds is 8 lakh, total funds is 10 lakh. Now, if I tell you that EBIT in each of these three companies stands as, let's say, 90,000. EBIT in these three companies is 90,000. Can you guys tell me how much is the return on capital employed over here? And how much is the return on net worth? Or how much is the return on equity in each of these three companies? Come on, give me the numbers, guys. Same numbers, that is the owned funds and borrowed funds, total funds is what we have. EBIT is same. Interest, PBT, taxes, and PAT. It is four numbers. You have to fill up and give me the return on capital employed, return on net worth in each of these scenarios. Yeah. Return on capital employed, how much is it? 9%. Perfect. Return on capital employed is 90,000 divided by 10 lakh into 100, which is 9%. And that's 9% going to be constant in each of these cases. Give me the number of return on net worth or return on equity. Return on net worth and return on equity. Return on net worth and return on equity. Come on, give me the numbers, guys. So, 0. Here it will be 50,000. Here it will be 80,000. Take tax as same 30%. Take the tax rate as 30% itself. PBT is 90,000. This 40, and this is 10,000. So taxes at 30% is 27,000. Over here it is 12,000, and in this case it is 3,000. We have profit after tax of 63,000. Then this is 28,000, and then this is 7,000. Now, give me what's the return on equity for P, Q, and R. For P, it is 6.3%, right? Because that's 63,000 divided by 10 lakh. And then we have over here PAT of 28,000 divided by 5 lakh into 100, which is again we say 5.6%. And last case is 7,000 divided by 2 lakh into 100, which is 3.5%. Yep. Are we getting these numbers? Perfect. So now, if you look at the entire game has changed, sir. The entire game has changed because now, sir, earlier it was this 77% return. That's the company R, which is the best one, right? And then over here, return on net worth, we say this 6.3% is the best over here. So earlier was a scenario when we said R is the best one. Over here we say P is the best one. R is the best one, and over there we say P is the best one. Now, why is it the case? Why is it a case that in first case we are having company R as the best one, and in the second case we have company P as the best one? Why is it happening? Can you tell me why is it happening? Let me tell you a very interesting thing over here. See, earlier, the business which these three companies were into, that business was giving 30% return. That business was giving 30% return, right? Whereas the funds that we have borrowed, sir, the funds that we have borrowed, those were carrying an interest of 10%. It means you were getting money at a cost of 10%, and you're investing in an area or investing into a business which gives you 30% return, right? You are raising funds which was 10%. Over here, you were investing it in a business that was giving you 30% return. So it was profitable for you because you get money at a cheaper cost and you're investing it at a higher return. So therefore, doing that activity, that is, borrowing money was beneficial when your return on capital employed was more than these borrowed funds. But then you look at over here, the return on capital employed is 9%, sir. And what you are borrowing is at 10%. Someone is giving you money at the cost of 10%. You're investing that 10% money funds at a rate of 9%. You're investing it at a rate of 9%. Obviously, there is a gap because you have to pay 10%, but you're getting 9%. Your returns will go down. If you take a loan thing, your returns will go down, right? And remember, this interest is a fixed cost that we have. This interest is a fixed cost that we have, right? So that fixed cost need to be borne, and for that you need to have sufficient level of EBIT. You need to have sufficient level of EBIT, right? So if you have sufficient level of EBIT, which means your business is so robust that it is able to generate return more than 10%, then it will add value to you. Then it is going to add value to you. Okay. So if you say which company has performed well, so it will depend on what is your EBIT level. Okay. So we say this coming to this capital gearing concept. Okay. How many of you know driving? Not the scooty ones, but the geared vehicles like the proper bikes or four wheelers, or maybe even bicycles will be sufficient enough to understand this concept. How many of you know driving? I hope you guys are aware of driving, right? So when you are driving or when you are running a cycle also, generally what happens is, you put the uh, vehicle into the first gear. I'm not talking of the automatic vehicles. I'm talking of the vehicles which are geared ones. So automatic vehicles I'm not talking of. So generally what happens, you put it in the first gear. Then as the speed increases, you increase the gear to second. As the speed further increases, you increase it to third, and then finally it goes up to fourth gear, right? So now when you are at fourth gear, when you are at fourth gear, what should be the speed of your vehicles? What should be the speed of the vehicle? So can you drive in the fourth gear? Can you drive in the fourth gear being at a speed of 20 kilometer per hour? Can you drive it at a speed of 20 kilometer per hour? Being in the fourth gear and you want to drive at 20 kilometer per hour speed, is that possible? Of course not, sir. If I want to be maintaining a high gear, I need to have a high speed also. If I want to run, if I want to run at a speed of, if I want to run at a lower speed, I need to have a lower gear. Check. Tell me, can you attain a speed of 100 kilometer per hour in first gear? Can you have it? Can you have the first? Can you have the first gear? Can you attain the speed of 100 kilometer in the first gear? Of course, not possible, right? So we need for high gear, high speed, low gear, low speed. The same goes over here, that here having a high gear, when you take more debt, that is what we call it as a geared situation or leveraged situation in finance. In finance, we say that your business is geared or your business is leveraged. Your business is geared or your business is leveraged when it is at more debt level. Okay. So when was having more debt beneficial to you? Can I say when your return on capital employed 30% is higher? When your return on capital employed 30% is higher or it's greater than your rate of interest, then only it is beneficial, sir. Or I can say you should have very great level of return on capital employed. You should have a very great level of return on capital employed, so that you should have a very great or a very high level of return on capital employed, so that you can sustain this gear, so that you can sustain this high level of gearing or high level of leverage. Now you will find that as your speed fell, the company which was highly geared, it suffered. It suffered, right? Whereas the company which was running on a low gear, it tried to maintain a balance, or it was somewhat best of all the things, right? So that's the gearing concept that we are talking of over here in this capital gearing ratio. Okay, so capital gearing ratio, it talks of the ratio between funds requiring fixed return upon funds which do not require fixed return. Remember, the funds that you're raising which require fixed return, those funds are said to be gearing your business. Funds required for fixed return, funds required for fixed return are actually adding gear to your business, or they are actually adding leverage to your business. If you have preference share capital, if you have debenture, if you have bonds, if you have bank loans, on them you need to be providing a fixed return, a fixed rate of interest, or a fixed rate of dividend. So those are the funds which are adding gears to your business. Whereas the funds which do not require fixed return, like our equity shareholders fund or equity share capital, you did not pay any interest, you did not pay any dividend or interest on them. And therefore they are said to be like not at all gearing your business, because there is no fixed obligation on it. Basically, capital gearing ratio, it measures the ratio between these two types of funds. One is the geared one and other is the ungeared one. So funds which require fixed return are going to be funds which require the fixed return are preference share capital and debt or borrowed funds, right? So we can say what is gear for us? It is a preference share capital as well as debt. And obviously speed over here is return on capital employed, right? And funds which do not require fixed return is the equity share capital plus reserves minus fictitious assets. So preference share capital plus debt upon equity share capital plus reserves minus fictitious assets. Okay. So debt means all sort of debts, even the short-term ones. Okay. So preference share capital and debt on the numerator, which are adding gear to your business. And in the denominator, you have the equity share capital plus reserves minus the fictitious assets. Okay. Is this clear? Capital gearing ratio, guys. Is this formula clear to everyone? Capital gearing ratio. Yes, clear, guys. Fantastic. Karthik is asking, so debt is gear, ROC is paid. Yes, correct, Karthik. ROC should be high if you want to keep debt proportion high and vice versa. True. Correct, Karthik. Okay, guys, so that's the capital gearing ratio that I wanted to talk to you. Then, next point that we want to discuss about this is long-term solvency. Don't you think we should also consider not only the ratio between equity and debt, but rather we should consider the ability to pay dues on time, and how do we measure that ability? So, for example, let's say there are three persons X, Y, Z, and we say salary of Mr. X is 1 lakh, salary of Mr. Y is 50,000, salary of Mr. Z is, let's say, 60,000. And they have an EMI, equated monetary installment payable, as 20,000, 25,000. Let's keep it as 20,000 only. And over here it is 20,000. Now tell me, out of these three persons, which one do you perceive to be having a lower risk if you want to grant them loan? For the purpose of granting loan, on which EMI is going to be, let's say, 20,000. So tell me which one of these three persons are going to be more reliable or less risky option for you? Is having a less risk? X is having lesser risk? X is having a lesser risk? Why do you say that X is having a lesser risk? What makes you say that, sir, X is something which is having a lesser risk? What is it? Why do you think that X is having lower amount of risk? Salary of 1 lakh, EMI of 20,000. Why do you feel so? Say, if I ask you a very simple question, sir, as to how many times, how many times of EMI is salary? In the first case, you will say, so the salary is 1 lakh, EMI is said to be 20,000. We say it is 5 times. It means whatever is your income, that is 5 times of the outflow of funds that you are looking at, that is your EMI. So 1 lakh divided by 20,000, which is 5 times. Y is 50,000 divided by 20,000. 50,000 divided by 20,000, which is 2.5 times. It means the income of Mr. Y is 2.5 times of the EMI. And in case of Z, you say it is 60,000 divided by 20,000, which is 3 times. So, of course, any person who is having a higher level of income as compared to the EMI portion, he or she is supposed to be having a better ability to service it, right? So X is having income which is 5 times of EMI. Y is having income which is 2.5 times of EMI. Z is having income which is 3 times of EMI. So of course, X is a safer bet, right? So based on this concept as to ability to pay the loan, and ability to repay the principal and the interest, we have got certain ratios for that. And those ratios are first up, interest coverage ratio. So interest coverage ratio, it talks of how many times of interest is EBIT. How many times of interest is EBIT? The interest coverage ratio, we say we have a EBIT upon interest, right? So as compared to interest, what is the income that I have? I hope every one of you agree with me that from EBIT only you are going to pay interest, because you subtract interest from EBIT. You subtract interest from EBIT, and that's what we say as the interest coverage ratio. Right? So EBIT upon interest, it tells you how many times of your interest is EBIT, or you can also say, sir, it gives you for rupee 1 interest, how much is EBIT. If I tell you interest coverage ratio is, let's say, 5, it means for every 1 rupee of interest that you have to pay, you are earning 5 rupee as income. Okay, that's your interest coverage ratio. Then next one is preference dividend coverage ratio. Now, what do we know? What do we need to have to pay the preference dividend? What do we need to earn to have a preference dividend? So we need to earn profit after tax to pay preference dividend, because unless and until I have preference dividend, I cannot pay profit after unless and until I have PAT, I cannot pay preference dividend, right? So this preference dividend coverage ratio, it tells us preference dividend coverage ratio, it tells us how many times of preference dividend is profit after tax. How many times of preference dividend is profit after tax? Okay. Or it tells you for 1 rupee of profit after tax, how much is, for 1 rupee of preference dividend, how much is profit after tax? Now, of course, in both these cases, can you tell me what do you say about these ratios? Are these ratios higher the better or lower the better? Are these ratios higher the better or lower the better? These two ratios that we just mentioned, interest coverage and preference dividend coverage ratio, are they case of higher the better or lower the better? Higher the better or lower the better? Yeah. Yep. Higher the better. Definitely, guys. Higher the better. It is, these ratios are always higher the better because that indicates a better level of security or better sense of security on the investors. Okay. Now, other ratio is fixed charge coverage ratio. Now, this fixed charge coverage ratio, the ratio says you take EBIT, but on that add depreciation. Take EBIT, and on that you add the depreciation, and then divide it by interest plus principal payment or principal due or principal repayment, basically. Fixed charge coverage ratio, we say it is EBIT plus depreciation upon interest plus principal repayment. Okay. So basically what we consider over here is, in this EBIT, we would have subtracted the depreciation. Now depreciation is not a cash expenditure. It's a non-cash item, right? So depreciation is a non-cash item. So since it is a non-cash item, we just add it back to EBIT to make this income as a cash income, right? So add the depreciation, because when we computed EBIT, we have subtracted the fixed cost, variable cost and fixed cost. In that fixed cost, we would have subtracted the depreciation also. So it means EBIT is not a cash profit. To make it a cash profit, I add a depreciation. And I want to see what is my capability to pay the overall interest as well as the principal payment, both the things. So over here in interest coverage, we're looking at our ability to pay only the interest. Here we are looking at the ability to pay interest as well as the principal. Okay. Then debt service coverage ratio. Debt service coverage ratio is going to be earnings available for debt service. The whole thing divided by interest plus repayment of principal. So what is the earnings that we have available for debt service? We say we'll start with PAT. On that, we will add back non-cash operating expenses. Also add back any interest. Okay. So that will give you the earnings available for debt service. And also we add or less any sort of adjustments. Any sort of adjustments. So PAT plus non-cash operating expense plus interest plus or minus adjustments. Okay. So these adjustments are basically any sort of, you have non-operating items which are not on a repetitive basis or are not so recurring items, right? So non-operating items need to be adjusted to come at this debt service coverage ratio. So both these ratios are indicating what is your ability to repay the loan, right? What is your ability to repay the loan? Okay. So these are the fixed charge coverage ratio, debt service coverage ratio. It tells you the ability to repay the loan. Now, when you're repaying the loan, you need to pay the interest as well as the principal, right? So earnings available for debt service is, we say, the PAT, whatever is your profit. On that, you add the non-cash expenses. On that, you add the interest, because when you computed PAT, you would have subtracted the interest to add it back so that we know what is the cash available with us to repay the interest. And then any sort of adjustments. Now, these adjustments are basically non-operating items. These adjustments are basically non-operating items. Okay. Fine. This is the coverage ratios that we have. The first two ratios tell you whether you are capable to pay interest, and first one says pay capability to pay interest. Preference, this tells you ability to pay the preference dividend. Fixed charge coverage ratio tells you whether you are capable of repaying the principal, and this also tells you the same thing but with a different approach, because it considers the non-operating items and non-recurring items. If you have in the profit any non-operating income, you will subtract it. When you have any non-operating expense, you will add it back, because all those non-operating, non-recurring, right? So non-operating, non-recurring, that's what we say as the adjustment part. Okay. Viral is saying debt service ratio include interest and installment, not the repayment of loan. Now, interest and now Viral, when you're repaying the installment, there is nothing but the principal repayment. So one and the same thing. Principal repayment and installment paid is one and the same thing. Just one and the same thing. Principal repayment and the installment of the loan. Difference between numerator of fixed charge and debt services are adjustments only. Yes, true. Correct. Then we are talking of only the adjustments in this case. Okay. So these are our coverage ratio. Next, we have to understand how are we going to effectively utilize our resources or utilize our assets. That's going to be calculated using the turnover ratios. So we will look at the turnover ratios after a break of 10 minutes. We'll look at the turnover ratios and then we'll go ahead with the questions. We'll go with some questions on from the module itself. We'll solve certain questions based on this. Okay, guys. Let's take a break of 10 minutes now. Okay, guys, welcome back after the break. So, Hiral is asking why in the numerator and denominator both interest is taken for debt service coverage ratio. Interest is taken for why in the numerator debt service coverage ratio. The interest is just added back, Hiral. PAT, you would have computed PAT as what? After subtracting interest, right? You get PAT as what? EBIT minus interest minus tax. We have already subtracted interest in it. So we add back interest to know what is my total income. Basically, if you are earning 100 rupee and you are spending 20 rupees, you're left with 80. Now, if I ask you that what is the ratio of your income to your expenditure, you will obviously say that 80 plus 20, which is 100 upon the expenditure of 20, right? So 80 plus 20 you do, and that's what we say, PAT plus interest. Okay, fine. Let's go for the next thing, which is along with short-term and long-term solvency, efficiency of company, we also need to be checked. How to measure whether a company is actually efficiently utilizing its resources. We need to check how the company is utilizing its resources. So let's say if we have two companies, A and B, company A is having a sales of 1 lakh. Company B is also having a sales of 1 lakh. But then tell me, if company has a total assets of 50,000, company B has total assets of 20,000. Can you tell me which of these two companies are utilizing the resources to the best possible way? Which of these two companies are utilizing the resources in the best way? Is it company A or is it company B? Is it company A which is using the resources in the best way, or is it company B which is using the resources in the best way? Yes, tell me, guys. Which of these two companies are utilizing the resources in the best way? Company B? Of course, yes, company B, because we say over here total assets turnover. Total assets turnover 1 lakh divided by 20,000, which is basically 1 lakh divided by 20,000, which is 5 times, right? 5 times, or I can say my sales is 5 times of the total assets. Sales is 5 times of total assets. And this is 1 lakh divided by 50,000, which is 2 times. So, sir, company A is able to have a sale of 1 lakh with the asset of 50,000. Company B is able to have a sale of 1 lakh with the asset of 20,000. So, in that situation, we say that total assets turnover ratio will be 2 times and 5 times. Okay, so company A is having twice its total assets as sale. Company B is having 5 times its total assets as sales. So of course, company B is doing a business better, right? So turnover ratio, we say company B is having a better turnover ratio. Okay, now just as we said that this is our total assets, total asset, how my company is utilizing total assets to the best possible extent. Same way, we are going to look at some more concepts like this, not total assets, but some other assets also to be taken into consideration. So total asset turnover, as we have discussed, it is sales upon total assets. Sales upon total assets. Now total asset turnover ratio, it's sales upon total assets. So we say sales or cost of goods sold. Sales or COGS. So total asset turnover is sales or COGS, right? We can take either of them. I can take sales or I can even take the COGS depending on what information is available. Total assets. This indicates how efficiently I'm utilizing my total assets. Same way, if I want to know how efficiently I'm utilizing the fixed assets. Now remember, this total assets will be fixed asset plus current assets. Fixed assets will include, fixed asset turnover will include sales or COGS upon the fixed assets. Okay. Capital turnover ratio. Capital turnover. Now we know capital. Capital is basically the total assets minus the current liability. Or you can also say this is a net asset turnover ratio. This indicates how efficiently we are utilizing our net assets. So again, in the numerator, you will have sales or COGS. Current assets turnover on the similar lines, it indicates how efficiently I'm utilizing my current assets. So it will be sales or COGS divided by the current assets. So when I want to say working capital turnover, how efficiently I'm utilizing my working capital, that will be sales or COGS upon working capital. And we know working capital is current asset minus current liabilities. Okay. So all these ratios, turnover ratios, total asset, it indicates how efficiently we are utilizing total assets, how efficiently we are utilizing fixed assets, how efficiently we are utilizing the net assets, current assets, and working capital. These are all efficiency ratio or activity ratios, how actively is the assets being used. And over here, of course, the fixed assets are after depreciation. Right? So depending on the information, if the question is giving you information about COGS, you should use COGS. If there is no information about COGS, then you should be calculating using sales figure. Okay. So working capital, it is current asset minus current liability. Okay. Now we have something really interesting ratio, which is inventory or stock turnover ratio. Okay. Let's understand this with the help of a case. Let's say A and B. Company A and B. Let's say company A has a stock of 3 lakh, or I call it as average stock of 3 lakh. COGS of 12 lakh. Average stock of 3 lakh, COGS of 12 lakh. Now, if I ask you in how many months will the stock get sold fully, or you can say in how many months will the stock be finished? Or one second, before I ask you this, let me ask you one question, and then we'll go to this. You have an average stock of 3 lakh. You have a COGS of 12 lakh. Okay. If I ask you how many times one lot of stock will be sold in a year, what will be the answer for this? What will be your answer for this? If your average stock is 3 lakh, COGS is 12 lakh. In full year, you're making a sale of goods costing 12 lakh. The entire year, you're making a sale of goods costing 12 lakh. And on an average, stock that you have is 3 lakh. So how many times are you going to sell this 3 lakh? Can I say you will be selling this 3 lakh 4 times in a year? 3 lakh plus 3 lakh plus 3 lakh plus 3 lakh. So in total, you are going to sell it 4 times. Correct, guys? In a year, you will be selling it 4 times because 3 lakh, 3 lakh, 3 lakh, 3 lakh, 4 times, 4 lots when you're going to sell. It's at that point of time you will say that I have achieved a COGS of 12 lakh, right? So that's exactly what we call it as stock turnover ratio. That's exactly what we call it as stock turnover ratio. And that stock turnover ratio is basically computed as COGS upon average stock, right? So over here, COGS is 12 lakh upon average stock is 3 lakh, which is 4 times, right? So how many times are we selling, sir? 4 times. Perfect. Yeah. So that's what we mean by uh, the average, or I can say the inventory turnover or stock turnover. That is telling us how many times we are selling one lot of the stock in a year. Now, suppose if I tell you there is another company B which is having an inventory or a stock turnover of, let's say, 5 times. Can you tell me which of these two companies is efficient? Company A is having a stock turnover of 4 times. Company B is having a stock turnover of 5 times. Can you tell me which of these companies are having better efficiency? Which of these companies are having, efficiency? Which of these two companies are efficient? Which of these two companies are efficient? Company B is efficient. Exactly, guys. Company B is efficient because 5 times means you're able to sell. If I assume that your average stock is same 3 lakh, obviously your COGS would be 15 lakh. So that is where you're saying 5 times. So with 3 lakh stock, company A was able to sell 12 lakh worth of goods. Company B was able to sell 15 lakh worth of goods. Of course, company B is more efficient, sir, because with limited resources, it's able to attain a higher degree of sales. So now if I ask you another question, that how many months would be required, how many months would be required to, how many months would be required to sell one lot of average stock? What will be the answer for this? See, in a year, you are selling 4 times. In a year, you are selling 4 times. Now, in a year, we have 12 months. And in that 12 months, you're going to sell 4 times. So one time will be like 3 months. Or basically, I can say after every 3 months, you're making your sale. After every 3 months, you're making your sale. Like at 0th month, you made a sale, then in 3rd month, then in 6th month, then in 9th month, right? So in a year, you will be making 4 times sales. So frequency of the gap between the two sales is 3 months, right? So you'll require 3 months to liquidate it. Now tell me, what about this 3 months number? Would you like to have this number of 3 months as higher the better or lower the better? Would you like to have 3 months stock? Would you like to take 3 months time to sell 1 unit of stock? Or should it be higher the better or lower the better? Yes, tell me. Lower the better, right? Because we would like to have a stock for a minimum. Like the better, the quick I'm able to sell my goods, the quicker able to sell my goods, that's good for me, right? If I'm taking 3 months to sell 1 unit of goods and there is another company, let's say in our case, if it is 5 times, so you will say 12 months divided by 5. So that's 12 months divided by 5 will give you answer as 12 divided by 5, which is 2.4 months. So the company B is better, right? Because it is able to sell the same lot of goods at a lesser duration. It's able to sell the goods at a lesser duration, that is in a time span of just 2.4 months as compared to 3 months. So it is lower the better. Okay. Receivables turnover. Receivables turnover. Now, receivables turnover is basically understanding how we are managing our receivables. So let's say if I give you the credit sales figure, credit sales is 24 lakh. Okay. And the average debtors is, let's say, 8 lakh. So you are selling in a year in totality 24 lakh, 24 lakh worth of goods, and you are able to collect or after a certain duration of time, and on an average, you maintain a debtor of 8 lakh, right? So if I ask you how many times in a year, how many times in a year we sell goods to debtors, what will be your answer? In a year, how many times are we selling the goods to our debtors? 3 times, right? Because so total 24 lakh is the sales, 8 lakh is the average debtors. On an average, we maintain a debtor level of 8 lakh. So 24 lakh divided by 8 lakh, that is 3 times, right? And same way, if I ask you how many months, how many months does it take? How many months does it take to collect money from debtors? Tell me. If in a year you are selling 3 times, how many months do you take to collect money from the debtors? In a year you are selling 3 times. What is the duration that you take to collect money from debtors? Can I say in a month you have 12 months, in a year you have 12 months, and in that 12 months you are selling 3 times. So basically 4 months. And this 4 months is debtors collection period. This is the time period that you take to collect money from your debtors. Because in a full year, you are selling 3 times. So every 4 months, you sell the goods today, collect the money after 4 months. Again, you sell the goods, collect the money after another 4 months, right? So now tell me, what about these two numbers? Receivables turnover. Is it higher the better, lower the better? Yep. Receivable turnover, higher the better, lower the better. Lower the better. Receivables turnover, is it lower the better? Would you like to sell only 2 times in a year to your customer, or would you like to sell it again and again? Would you like to sell 3 times in a year? Higher the better, guys, because understand, for same 24 lakh, if I tell you that, let's say the debtors are just 2 lakh. So this is going to be what? 24 by 2. It means 12 times. So if your debtors turnover is higher, it means you are maintaining a lesser degree of debtor. If your debtors turnover is higher, it means you are maintaining a lesser amount of debtors. So less amount is tied up in the business, right? And how many months does it take? Of course, this is like lower the better. Yeah. Now, same way, if I ask you payables turnover, payables turnover will be credit purchases divided by average creditors plus average bills payable. This is again going to tell you uh, how many times in a year, purchases are made from creditors. Purchases are made from creditors. Okay, fine. Let's look at some more ratios quickly, guys. How to check if a company is generating adequate profits? To check whether we have already discussed return to the investor category, return on investment. Now, based on sales thing, all these ratios are having a general format that everything is going to be upon net sales. Even net profit ratio is upon net sales. This is also upon net sales. So gross profit ratio will be what? Gross profit upon net sales into 100. Net profit ratio will be net profit upon net sales into 100. Operating profit ratio will be EBIT. Remember, EBIT upon net sales into 100 because EBIT is your operating income. Now, the other ratios, COGS ratio, it is of course COGS upon net sales into 100. Operating expense ratio is basically admin expense plus selling expense plus finance expense upon net sales into 100. Operating ratio is COGS plus operating expenses upon net sales into 100. Similarly, finance expense ratio will be finance expense upon net sales into 100. So all of these ratios are indicating what percentage of your net sales is the respective profit or the expenditure. Okay. Fine. Let me look at the query. Lower the better. Fine. What is raw material inventory turnover ratio? Raw material inventory turnover ratio is the same thing. Stock turnover ratio. So instead of the overall stock, you're talking of only raw material, right? So only the raw material. So the formula will be like cost of production upon your average inventory stock, average raw material. Okay. Net sales and sales are same. Yes, net sales is after adjusting for the sales return. Okay. Fine. Yes. So we have done sufficiently good number of questions now, good number of formulae. Almost everything is done. We have few formulae left that will be taking up in our revision class. But before we go for those formulae, let us do one thing. Let's try to solve a question now. Let me just place a question in front of you so that we can start solving it. Okay. Can you see these two questions, guys? Are you able to see the questions? Just confirm, guys. Are you able to see the questions? Yep. Sure. Fine. If you wish, you can just take a screenshot of this, because one question we'll be doing, one will be giving you as homework for practice. Okay, we'll have more questions to be practiced in the upcoming revision class of the ratio analysis also. Take a screenshot of it, or anyways, I'll keep the question in front over here. So go through the question for a minute, guys. The first question. Through the question for a minute. Okay, fine. Let's begin. See, based on the following information, we have to prepare the balance sheet of Stellar Limited on 31st March. So let's look at the balance. Let's look at the numbers. We have been given current ratio, liquidity ratio, net working capital, stock turnover ratio, gross profit to sales, COGS to net fixed assets, average debtors collection period, fixed asset to net worth, long-term debt to capital and reserves. Okay, these are the ratios that are given to us. We have to prepare the balance sheet, and the detailing has to be given as much as possible based on whatever figures we have. As much as possible, we have to give the detail. Okay, so let's begin with the very first ratio. We have the current ratio information given. Now, we know current ratio is given as 2.5, and we know that is current ratio is current asset upon current liability is 2.5. So from this, we can say that current asset is 2.5 times of current liability. This is our first question. This is the first equation rather. Okay. Now, connected with this current ratio, do we have any other further information on which I can apply this current ratio? Do I have any further information on which I can apply this numbers? Yeah. This current ratio is 2.5 to current asset is 2.5 times of current liability. Do we have any other information? Exactly, sir. We have this net working capital information. Let's use that net working capital information. We've been given net working capital is 6 lakh. Net working capital is rupees 6 lakh. Right? Now, this net working capital, we know that it is computed as current asset minus current liability is 6 lakh. The second equation. Can I substitute something? Definitely, sir. I can substitute the first equation over here. We'll say substitute 1 in 2. So 2.5 times of current liability. So I'm just substituting this over here, 2.5 in the current asset. 2.5 current liability minus current liability is given as 6 lakh. We have this as 1.5. Current liability is 6 lakh, which means current liability is 6 lakh divided by 1.5. So how much is this current liability? What's the number of this? What's the amount of this current liability? 6 lakh divided by 1.5 is 4 lakh. Right? Current liability is 4 lakh. So once we have current liability, can we compute the current asset also? Yes, definitely. We can say current asset is 2.5 times of current liability, which is 2.5 into current liability of 4 lakh. So this is into 2.5, which is 10 lakh. The current asset is 10 lakh. Current liability of 4 lakh, current asset of 10 lakh. Okay, this is what we got based on current asset and net working capital. We use these two ratios. Now it's turn to use some other ratio and try to get some more values. Which is the other ratio that we can use? Obviously, it's the liquidity ratio. Now, this liquidity ratio, we have it as 1.5. Liquidity ratio is 1.5. We know liquid ratio or quick ratio or acid test ratio. It was current asset minus stock minus prepaid expenses upon current liability. But there is no information in the question regarding prepaid expenses. And generally, we can safely assume that the company doesn't have any prepaid expense. So we can eliminate this prepaid expense from here and we can just compute liquid ratio as current asset minus stock upon current liabilities. The liquid ratio is 1.5 is equal to current asset of 10 lakh minus stock is of some value which we don't know upon a current liability which we computed current liability of 4 lakh. We say 1.5 into 4 lakh is 6 lakh is equal to 10 lakh minus stock. We say stock is 10 lakh minus 6 lakh, which is 4 lakh. So we got another information that stock is valued at 4 lakh or inventory is valued at 4 lakh. So we have used liquidity ratio also. Now, so connected with this, we have stock turnover ratio. Stock turnover ratio. So we have stock turnover ratio given. Stock turnover ratio, we know the formula. Stock turnover is COGS upon average stock. Do we have any information regarding opening or closing stock? Any information regarding opening and closing stock? No, sir. So stock turnover ratio 5 is equal to COGS to net fixed assets. Sorry, COGS upon average stock, we know it is 4 lakh. So COGS will be 4 lakh into 5. 4 lakh into 5, which is 20 lakh. So COGS is 20 lakh based on the stock turnover ratio. Right, guys? Fine. So we'll use this stock turnover. Now the next one, next ratio that we have to use is, yes, Gajalakshmi, go ahead and ask your doubt. Answer it. So COGS is 20 lakh. Now we have gross profit to sales is 20%. Gross profit to sales is 20%. We have GP upon sales into 100 as 20. Now, how do we get this GP, sir? This GP is sales minus COGS upon sales into 100 is 20. So we don't know what is sales, but we know that COGS is 20 lakh. We know that COGS is 20 lakh. Okay. So minus 20 lakh upon sales into 100 is 20. How many maps is this chapter comprised of, sir? There is no specific rule book for how many marks. How did you get 4 lakh of stock? Simple, by using liquid ratio. Liquid ratio is current asset minus stock upon current liability. So I had current assets of 10 lakh, I had current liability, put it over and I got the value of stock. Average stock is 4. See, whatever the stock is, that itself is my average stock and also the closing stock, because no information is given regarding the opening stock. I assume that opening is also 4 lakh. Therefore, the stock remains as 4 lakh. Okay, you need not take half of 4 lakh. So when you have average stock, it is opening plus closing divided. Okay, now over here we have to get the value of sales. Sales is basically going to be sales minus 20 lakh is equal to 0.2 times of sales. Sales minus 0.2 times of sales is 0.8 times of sales is 20 lakh. We say that sales is 20 lakhs divided by 0.8, which is 25 lakh. We got the sales figure as 25 lakh. Okay, so this is used. Now we have COGS to net fixed assets as 2. COGS to net fixed assets. Okay, so as per the formula, we have COGS upon fixed asset as 2. We know COGS is 20 lakh. COGS is 20 lakh upon fixed asset is 2. Therefore, fixed asset is 10 lakh. Okay, we got a fixed asset of 10 lakh value. COGS to fixed assets. This ratio is also used. Now I have to use the next ratio, which is average debtors collection period as 2.4 months. Okay. Average debtors collection period is 2.4 months. Average debtors collection is 2.4 months. Now, how do we get this 2.4 months? How do we get the average debtors collection? We have said that it is 12 divided by debtors turnover, which is 2.4. Right? So, debtors turnover ratio will be 12 divided by 2.4. 12 divided by 2.4 is 5 times. And we know that debtors turnover is given as credit sales upon average debtors. Now remember, in this question, there's no information regarding how much of your sales is on cash and how much is on credit. There's no information regarding that. How much is on cash and how much is on credit. So debtors turnover is basically 5. So we take entire sales as credit itself. So what's the sales that we have computed? Sales is 25 lakh. Sales is 25 lakh divided by average debtors. From this we can get our average debtors as 25 lakh divided by 5, which is 5 lakh itself. 25 lakh divided by 5, which is 5 lakh itself. That's the average debtors value. Right? So average debtors is 5 lakh. And since there's no again information regarding opening and closing, this itself will be the debtors value. Then our balance sheet will write that debtors is 5 lakh. Okay, so average debtors collection is done. Next ratio is fixed assets to net worth. Fixed assets to net worth. We have fixed assets to net worth as 0.8. Now what's the fixed asset, sir? Fixed asset was 10 lakh. We say 10 lakh upon net worth is 0.8. Therefore, our net worth will be 10 lakh divided by 0.8, which is 12.5 lakh. 10 lakh divided by 0.8, which is 12.5 lakh is the net worth. Right? Now, we said, sir, net worth is 12,50,000. Remember, this net worth is, sir, equity share capital plus reserves, because no information is given regarding the preference share, so we are simply ignoring that. Okay. So we have equity share capital and reserves as this term. Then the next ratio that we have got is long-term debt to equity share capital and reserves. Next ratio is long-term debt upon net worth, basically. Because when we say equity share capital and reserves, it's the net worth. That's given as 7 by 25. So long-term debt upon 12,50,000 is equal to 7 by 25. Therefore, long-term debt is 7 by 25 into 12,50,000. So we can say that long-term debt is 7 into 12,50,000. $12,50,000 divided by 25. So long-term debt is 3,50,000. Right, guys? So we have utilized all of it. Yes, we are assuming entire sales as credit. Karthik, meaning of net worth is the owned funds, equity share capital, and the reserves. Okay, so we have used all the resources and we have sufficient values over here. Now it's time to fill up the balance sheet, guys. Let's fill up the balance sheet. Let's look at what all values do we have in the balance sheet. We have got current asset value. We have got current liability value. The balance sheet, we have current assets and current liabilities. In the balance sheet, we have current assets and current liabilities. Total values of current asset and current liabilities are given to us. Current asset was 10 lakh, current liability was 4 lakh. Current asset is 10 lakh, current liability is 4 lakh. Now, in this current asset, we have information regarding um, the stock, right? How much was the stock? The stock was 4 lakh. We computed the stock as 4 lakh. The stock we have worth 4 lakh. So we also computed the debtors. I suppose debtors also computed as 5 lakh. Debtors is also calculated as 5 lakh. Let's take that as 5 lakh debtors. Any guesses, guys? What should be this balancing 1 lakh? Any guesses, guys? What should be the balancing 1 lakh? Because my current asset is standing as 10 lakh. My current asset is 10 lakh. So what is this balance? So balance is definitely the cash and bank component. Okay. Then we also computed the fixed assets. We also computed the fixed assets. Fixed assets stand as 10 lakh. Then we have long-term debt as 3,50,000 and equity share capital and reserves. There's no further bifurcation of this. So equity share capital and reserves, it is 12,50,000. Check, is your balance sheet tallying at 20 lakh? Balance sheet is tallying at 20 lakh, right? Are you getting this balance sheet tallied amount of 20 lakhs? Balance sheet is 20 lakh, right? Yep. Karthik, profit is already included in this portion because it is equity share capital plus reserves. Okay. Very guys, perfect. So we have one more question for you, which you have to solve it at home. I will be uploading this file on the portal, so you can download it and solve it uh, when we meet the next class. We'll discuss the solution for that. Okay. So we still have got some time. So I think we should go ahead with the pending return ratios also. Pending some market ratios. Now, let's say if I tell you a company has net profit or equity shareholder figure. Net profit for equity shareholders is, let's say, 10 lakh. And the company is having number of equity shares as 5 lakh. Can you tell me per share, how much did the company earn? Per share, how much did the company earn? Yeah, in exam, T-form balance sheet is allowed, guys. We are not preparing a financials of a company, financial statements of a company as per Companies Act. It's for your financial analysis purpose, so you can prepare it in T-form. Second question, I'll not zoom it, I'll upload it on the portal, guys. Okay. So if I tell you earnings per share, then every share, what's the earning? Or every share, what is the earning that we are having? You'll say, sir, this is 10 lakh divided by 5 lakh, which is 2 rupees, right? So earnings per share for equity shareholders, they say that it is 10 lakh divided by 5 lakh. Now, what was the 10 lakh? 10 lakh was net profit for equity shareholders upon number of equity shares. So if I tell you that dividend company, let's say, out of this net profit for equity shareholder, dividend paid by company is suppose 6 lakh. Can you tell me what is the dividend paid by company on per share basis? What is the dividend paid by company on per share basis? Can you tell me how much is the dividend paid by company on per share basis? Dividend paid by company on per share basis. So it is 6 lakh paid to 5 lakh shareholders. Right, there are number of shares is 5 lakh. So 6 lakh paid to 5 lakh shareholders. So that's going to be 1 point. So my dividend per share formula will be dividend paid upon number of equity shares. Simple. Now if I tell you out of 2 rupee, 1.2 is paid as dividend per share. Out of 2 rupee, 1.2 rupees paid as dividend per share. So tell me what percentage is paid out as dividend. So out of 2 rupee, you are paying 1.2 as dividend. So can I say it is 60%? So 60% of your income is paid out as dividend. So the formula for this goes as dividend per share upon earnings per share into 100. Dividend per share upon earnings per share into 100. That's your dividend payout ratio. Retention ratio. So if 60% is paid, how much are we retaining? So we are retaining 100 minus 60%, which is 40% is retaining. So this is basically 100% minus dividend payout ratio. Right? Then we have P ratio. We'll come to that later. Dividend yield. Let's say in this case, we had a dividend per share as 1.2 and market price of share is 10 rupees. So tell me by buying this share at 10 rupees, I'm getting a dividend of 1.2. So how much return am I getting? I'm getting, sir, 1.2 on an investment of 10, which is basically 12%. Right? So the formula goes as dividend per share upon market price per share into 100. Now we had like earnings as 2 rupee. So tell me by buying this share at a price of 10 rupee, you're getting EPS as 2 rupee. So what is the rate of return that you're getting, sir? 2 on an investment of 10, which is 20%. Earnings yield is EPS upon MPS into 100. EPS upon MPS into 100. Coming to P ratio. As the name says, it is price to earnings. Price is basically MPS, earnings is basically EPS. Now to understand the relevance of it, let me take an example. Let's say there are two companies having the EPS of 10 and 10, but market price of share over here it is 100, and here it is 150. So P ratio will be, sir, 100 by 10, which is 10, and this is 150 by 10, which is 15. Okay. So looking at these two companies, that's if they're having the same EPS, but market price of one is 100 and the other is 150. So tell me which one of these two companies are having a better P ratio? Obviously, why, sir? If I ask you which of these two companies are having a better investor confidence, what will be your answer? Which of these two companies are having better investor confidence? Out of these two companies, which company enjoys a better investor confidence? Is it X or is it Y? It is definitely Y, guys, because X gives you the same EPS, but people are buying it at 100 rupees. But for same company, for same earnings of Y, people are ready to pay more. So here for Y, the investors are ready to pay more for getting the same return. So the confidence in Y is definitely higher. The confidence that the investor have in Y is higher because they're ready to pay a higher price for it. If I give you an example, let's say MI and Apple. In which company do people have more confidence? Is it in MI or is it in Apple? Of course, Apple. Why, sir? Because of its good quality, and therefore people are ready to pay more for it. So whenever you want to see on which product or on which share, on which instrument more confidence is there, you should always look at the price, right? Price in respect to what you are getting, what is your earnings. So over here, people are ready to pay 150 for earning 10 rupee, and therefore we say Y is having a greater degree of confidence. The P ratio is a measure of our confidence. It's a measure of confidence. Okay. So these are the market ratios that I wanted to cover in this session. So with that, we are through with this session, guys. We'll have one more session. We'll have one more session in the probably in the coming week. Not coming week, but in the next week, wherein we'll be revising this ratio analysis and one more chapter again. So there will be solving more and more questions and understanding some more concepts in this. Okay. With that, let's just stop here for the day, guys. See you in the next class, guys. Bye bye and take care. Session complete, sir.